There's a meeting that didn't happen. You won't find it in the headlines. No press conference, no joint statement, just silence. In December 2024, the United States Treasury quietly floated an emergency proposal to Beijing. The details were vague, but the intent was clear. We need help. China's response came 3 weeks later. One word: no. That rejection isn't just diplomatic theater. It's a fracture in the architecture that's held global finance together for 50 years. And if you think this is just about trade wars or politics, you're missing the real story. This is about money, specifically about what happens when the two largest economies on Earth stop pretending they trust each other. Let's start with what most people don't understand about how the world actually works. The US dollar isn't just American currency, it's the currency. 70 countries peg their money to it. Oil trades in it, debt is denominated in it, central banks hoard it. When a company in Germany buys steel from Brazil, they settle the transaction in dollars, not euros or reais. This gives the United States an extraordinary privilege. We can print money to pay our debts. We can sanction countries by cutting off their access to dollar payment systems. We can borrow trillions at low interest rates because the world needs a safe place to park their cash. And US Treasury bonds have always been that place. But this system has a requirement. Other countries have to keep playing. And for decades, China did. They exported goods to America, earned dollars, then turned around and bought US Treasury bonds with those dollars. It was a loop, a deal. We got cheap products and cheap debt. They got jobs and economic growth, symbiotic, stable, profitable for both sides, until it wasn't. China holds over $800 billion in US Treasury securities. At its peak in 2013, that number was $1.3 trillion. They've been slowly selling for 11 years. Most analysts explain this away as diversification, portfolio management, nothing to worry about. But December 2024 wasn't about portfolio management. The emergency proposal from the US Treasury involved a coordinated intervention to stabilize currency markets. The details remain classified, but sources close to the negotiations described it as a request for China to significantly increase its purchases of US debt in exchange for concessions on tariffs and technology restrictions. Translation: we need you to keep lending us money and we'll ease up on the economic pressure. China's rejection wasn't just a refusal, it was a message. The old deal is dead. To understand why this matters, you need to understand what actually happens when a country buys another country's debt. Let's say China has $1 billion from selling electronics to American consumers. They could use that money to buy factories, real estate, commodities. But for decades, they bought treasury bonds instead. Why? Because treasury bonds are considered the safest asset in the world, risk-free. The US government has never defaulted. It's backed by the largest military, the deepest financial markets, the reserve currency. But safety isn't the only factor. There's also politics. By buying treasury bonds, China was recycling dollars back into the US financial system. This kept the dollar strong and the yuan relatively weak, which made Chinese exports cheaper and more competitive. It was a deliberate strategy, but it also created a dependency. If China suddenly stopped buying US debt, or worse, started selling it aggressively, interest rates in America would spike. Borrowing costs for everything from mortgages to corporate loans would increase. The stock market would react. The government would have to either cut spending or find new buyers for its bonds. This is the leverage, the quiet power of being a major creditor. And in December 2024, China decided to stop using that power to support the US economy. Let's zoom out. The numbers tell a story most people aren't paying attention to. US national debt, $36 trillion. That's trillion with a T. The interest payments alone are now over $1 trillion per year, more than the defense budget. To pay for this, the Treasury issues bonds, constantly. Every week, billions of dollars in new debt hits the market. Someone has to buy it. For years, foreign central banks were reliable buyers. China, Japan, European nations. But foreign holdings of US debt have been flat or declining since 2014. Japan is still a major holder, but they've got their own problems. Their economy has been stagnant for decades, and their debt to GDP ratio is the highest in the developed world. So who's filling the gap? The Federal Reserve and American institutions, pension funds, banks, money market funds. But here's the uncomfortable part. When the Fed buys treasury bonds, they're essentially creating money out of thin air. This worked fine when inflation was low, but after the pandemic spending, inflation spiked to levels not seen in 40 years. The Fed had to raise interest rates to cool things down. Higher rates mean the government pays more interest on its debt, which means it has to issue even more bonds to cover the interest payments, which means it needs even more buyers. It's a cycle, and it only works if people believe US debt is safe. China's rejection in December suggests they're not so sure anymore. Now let's talk about what the emergency proposal actually meant. This wasn't a routine diplomatic outreach. Emergency deals happen when someone is desperate, when the normal channels have failed, when time is running out. The fact that the U.S. Treasury approached China at all is significant. It signals vulnerability. It signals that private markets aren't absorbing debt as smoothly as they used to. It signals that the U.S. needs external support to stabilize its finances. But why China? Why not Europe or Japan or the Gulf states? Because China is the only country with the reserves, the surplus, and the capacity to make a meaningful difference. They're sitting on over $3 trillion in foreign exchange reserves. They run a massive trade surplus. They have the financial firepower. The question was whether they had the political will. The answer was no. Here's where it gets interesting. China didn't just reject the proposal. They simultaneously announced a series of measures to reduce their reliance on the dollar, new currency swap agreements with Russia, Brazil, and Saudi Arabia, expanded use of the yuan in international trade, increased gold purchases by the People's Bank of China. This isn't coincidence, it's strategy. For years, China has been talking about de-dollarization, moving away from dependence on the U.S. financial system, building alternative payment networks, internationalizing the yuan. But talk is cheap. The dollar's dominance is deeply entrenched. It's not just about currency. It's about trust, liquidity, legal frameworks, and network effects. You can't just create a rival system overnight. Except China has been working on it for a decade. The Belt and Road Initiative, the Asian Infrastructure Investment Bank, the Cross-Border Interbank Payment System, or CIPS, which processes yuan transactions outside the dollar network. None of these have replaced the dollar. But they don't need to. They just need to create alternatives, options, redundancies. And every time the U.S. weaponizes the dollar through sanctions or trade restrictions, it gives other countries a reason to find those alternatives. December 2024 might be the moment China decided the alternatives were good enough. Let's talk about what happens next. If China isn't buying U.S. debt, someone else has to. But who? Domestic buyers can absorb some of it. But there's a limit. Pension funds have allocation mandates. Banks have capital requirements. Individual investors want returns that beat inflation. If demand drops and supply stays high, prices fall. And when bond prices fall, yields rise. Higher yields mean higher interest rates across the economy. This is the nightmare scenario for the Federal Reserve. They're trying to engineer a soft landing, keeping inflation under control without triggering a recession. But if Treasury yields spike because foreign buyers disappear, their job becomes exponentially harder. They can step in and buy bonds themselves, but that risks reigniting inflation. They can let rates rise, but that risks crashing the economy. There's no clean solution. And this is just the U.S. side of the equation. China has its own problems. Their economy is slowing. The real estate sector, which drove growth for 2 decades, is collapsing. Local governments are drowning in debt. Youth unemployment is at record highs. The population is shrinking. Xi Jinping has bet everything on tech self-sufficiency and manufacturing dominance, but that requires stability. It requires avoiding a financial crisis. So why would China reject an emergency deal that could have eased tensions and provided economic relief? Because accepting it would have meant capitulation. It would have meant acknowledging that China still needs the U.S. system more than the U.S. needs China. And that's not the story Xi is telling his people. China's leadership sees this as a long game. They're willing to endure short-term pain for long-term strategic positioning. They're betting that the U.S. financial system is more fragile than it looks, that the dollar's dominance is a historical accident, not a permanent feature. They might be right. Here's the part no one wants to say out loud. The global financial system runs on confidence. Not gold, not assets. Confidence. People hold dollars because they believe other people will accept dollars. Investors buy treasury bonds because they believe the U.S. government will pay them back. Banks settle transactions in the dollar system because they trust it won't collapse. But confidence is fragile. It's based on perception, momentum, and collective belief. When a major player like China publicly rejects an emergency proposal from the U.S., it plants a seed of doubt. Maybe the system isn't as stable as we thought. Maybe the rules are changing. Maybe we should hedge our bets. This is how cracks form. Not overnight, not with a dramatic crash, but slowly, as institutions and countries quietly shift their strategies. A little less exposure here. A few more gold reserves there. A new trade agreement that bypasses dollar settlement. Death by 1,000 cuts. Let's look at the immediate fallout. Global markets reacted, but not in the way most people expected. There was no panic, no sudden crash. Just a slow, grinding reassessment. The equity market stayed relatively stable, propped up by corporate earnings and central bank liquidity. But underneath the surface, volatility spiked. Bond traders started pricing in higher risk premiums for long-term U.S. debt. The dollar weakened slightly against a basket of currencies, but it didn't collapse. It never does. Currency markets move slowly, resisting dramatic shifts because too many players have too much invested in the status quo. But the trend is clear. Confidence is eroding. There's a broader context here that's easy to miss. The post-World War II global order was built on American economic and military dominance. The dollar became the reserve currency because the US had half the world's GDP and the only intact industrial base after the war. That world doesn't exist anymore. The US share of global GDP has shrunk. China's economy is roughly the same size depending on how you measure it. Europe is united. India is rising. The balance of power has shifted. But the financial architecture hasn't kept pace. The dollar still dominates. The IMF and World Bank are still run largely by Western countries. The rules were written 70 years ago. China isn't alone in noticing this. Brazil, India, South Africa, and dozens of other countries are asking why they should conduct all their trade in dollars, why they should be subject to US sanctions, why they should hold their reserves in assets controlled by a foreign government. These are reasonable questions. And December 2024 might be the moment they started demanding answers. Let's get tactical. What does this mean for actual money in the real world? If you're an investor, this complicates everything. Traditional portfolio theory says hold a mix of stocks and bonds. Stocks for growth, bonds for safety. But what if bonds aren't safe anymore? What if Treasury securities carry more risk than we've been told? You can't just sell everything and hold cash, because cash loses value to inflation. You can't move entirely into stocks, because equities are vulnerable to economic shocks. Some investors are turning to alternatives. Gold has been climbing steadily. Bitcoin and other cryptocurrencies have seen renewed interest despite their volatility. Real assets like infrastructure and commodities are getting attention. But these aren't perfect solutions. They're hedges, bets that the old system might not hold. If you're a business, this changes your risk calculations. Currency fluctuations become harder to predict. Supply chains get more complicated. Financing costs are uncertain. Companies that relied on cheap dollar-denominated debt to fund expansion are rethinking their strategies. International firms are exploring currency hedges and local financing options. If you're just a regular person trying to save for retirement, this is deeply unsettling, because the assumption underlying every financial plan is that the system is stable, that bonds are safe, that the dollar holds value, that pensions and Social Security will be there. What happens if those assumptions break? Here's the irony. The US spent decades promoting global integration, free trade, open markets, a rules-based international order. The idea was that economic interdependence would create peace and prosperity, and it did for a while. But interdependence works both ways. It creates leverage. It creates vulnerabilities. China isn't just a rival, it's embedded in the American economy. Supply chains run through Chinese factories. American companies earn billions selling to Chinese consumers. US debt is held by Chinese institutions. You can't decouple from that overnight. You can't turn an adversary into an enemy without collateral damage. Yet that's exactly what's happening, slowly, incrementally. The emergency deal that China rejected wasn't just about bonds and interest rates. It was a test, a last attempt to see if cooperation was still possible. The answer suggests it's not. So what happens now? The optimistic scenario is that this is a negotiating tactic, China playing hardball to extract better terms. Eventually, cooler heads prevail and some compromise is reached. The system wobbles but doesn't fall. The pessimistic scenario is that we're watching the beginning of a financial decoupling. Two parallel systems emerging, a dollar block and a yuan block, trade and capital flows splitting along geopolitical lines. History suggests the pessimistic scenario is more likely. Hegemonic transitions are rarely peaceful. When one power rises and another declines, conflict follows. Not always military conflict, but economic, political, and strategic conflict. We're living through that transition right now. Let's address the elephant in the room. Could the US simply not care? Could it let China walk away and find other buyers? Theoretically, yes. The US economy is still enormous. Domestic demand is strong. Innovation continues. The military is unmatched. But theory and practice are different things. In practice, the US government relies on foreign buyers to fund its deficits. In practice, higher interest rates would ripple through the economy, hitting everything from housing to corporate investment. In practice, losing reserve currency status would mean losing the ability to print money without consequences. Rome didn't fall in a day, but it fell. The British pound was the global reserve currency until it wasn't. Sterling balances accumulated overseas. Britain ran deficits. Wars depleted resources. And after World War II, the dollar took over. The transition took decades, but once it started, it was irreversible. Is that where we are now? Is December 2024 the equivalent of Britain's 1945? It's too early to say, but the parallels are uncomfortable. Here's what's not being discussed enough. Financial crises don't announce themselves. They build quietly, hidden in balance sheets and risk models and assumptions that seem reasonable until they're not. The 2008 financial crisis wasn't caused by a single event. It was caused by a slow accumulation of leverage, misaligned incentives, and blind faith that housing prices would always rise. Everyone saw the signals. Few acted on them. We're seeing signals now. Foreign central banks reducing treasury holdings, yield curves inverting and then steepening, volatility clustering in credit markets, governments scrambling for emergency deals. These aren't guarantees of collapse, but they're warnings. And warnings only work if someone listens. Let's talk about what China actually wants. It's not chaos. Despite what the hawks in Washington think, China doesn't benefit from a global financial meltdown. Their economy is too interconnected. What China wants is recognition, a seat at the table that reflects their actual power, a say in how global finance is governed, an end to a system where the US makes the rules and everyone else follows. This is about respect as much as money. The problem is that the US isn't ready to share power. American exceptionalism is baked into the political DNA. The idea that the dollar might not be supreme, that US bonds might carry risk, that other countries might have valid alternatives. These are difficult concepts for Washington to accept. So instead of negotiation, we get confrontation. And confrontation has consequences. There's a historical parallel worth considering. In 1971, President Nixon ended the convertibility of dollars into gold. The Bretton Woods system collapsed overnight. Countries panicked. Currencies fluctuated wildly. It seemed like the end of the financial world, but it wasn't. A new system emerged. Floating exchange rates, petrodollars, globalization. The dollar remained dominant, but the rules changed. Could something similar happen now? Could China's rejection force a redesign of global finance? Maybe. But transitions are painful. There's no guarantee the next system will be more stable, or fair, or functional. And there's no guarantee the US comes out on top. So where does this leave us? With a question no one wants to answer. What happens when the world's two largest economies stop trusting each other? Not just politically, financially. When China won't lend, when the US won't cooperate, when trade becomes a weapon and debt becomes a liability. We don't have a playbook for this. The Cold War offered a blueprint for military and ideological competition, but not financial. The Soviet Union wasn't integrated into the global economy. China is. This is uncharted territory. Here's what we know for certain. The emergency deal that didn't happen will have consequences. Not immediately, not in a single dramatic event, but in the slow recalibration of how money moves around the world. Countries are watching. Investors are watching. And they're making decisions based on what they see. If the US and China can't cooperate in a crisis, what does that say about the stability of the system? If treasury bonds aren't risk-free, where is safe? If the dollar's dominance is fading, what comes next? These questions don't have easy answers, but they need to be asked. Let me leave you with this. Money is a story we tell ourselves, a shared fiction that only works because we all believe it. For 70 years, the story was that the dollar is king, that US debt is safe, that global markets are stable. China's rejection in December 2024 is a crack in that story. Not the end, but the beginning of doubt. And once doubt enters the system, it spreads. History doesn't repeat, but it rhymes. Empires rise on confidence and fall when that confidence erodes. Currencies dominate until they don't. Systems persist until they collapse. We're not there yet, but we're closer than most people realize. The question isn't whether change is coming. The question is whether we'll see it in time to adapt, or whether we'll keep believing the old story until it's too late. The meeting that didn't happen. One proposal, one rejection, and the world shifted just a little. Barely enough to notice, but enough to matter.